Hello, everyone. This is Bharath Vellore. I'm the General Manager for the APAC region at Provenir. Thanks for joining the webinar today. I've got a fantastic set of panelists here with me discussing a great topic around customer-centric risk decisioning, digital lending, all very relevant in the current times. Without any further delay, I'll have Clayton introduce himself. Clayton, over to you.
Thanks, Bharath. Good morning, everyone. I'm Clayton Howes. I founded MoneyMe in 2013 and growing the business to now having originated over $3 billion under the MoneyMe brand, and also with the familiar brand to quite a lot of people is Society One, another fintech in Australia that's as a combined group. And it's given me the opportunity to do something great, putting technology, really amazing people together to create a culture that is intended to disrupt the traditional ways that finance has been understood and distributed to consumers. And the journey continues 10 years in. It's an exciting time, and I'm sure we'll get into some of the more interesting stuff that Bharath is going to be teasing out of us. Thank you.
Absolutely. Thanks, Clayton. Joanne, if you could please introduce yourself.
Sure. Morning, everyone. Yeah, my name's Joanne. I'm Wisr's Chief Risk and Data Officer. I've been at Wisr about 3.5 years. Wisr is a similar company to MoneyMe. We also operate in the non-bank lending, and we're a neo-lender, solely digital, but we also have a purpose around supporting Australians with their financial wellness. So as well as offering credit solutions, we also offer apps and solutions that help people manage their credit or understand their financial wellness, have access to coaching material, etc., that can help them improve and reach their financial goals. Super excited to talk about this topic. I've been around sort of credit decisioning and risk for about 20 odd years now, so happy to get stuck into it.
Thanks, Joanne. Very quickly on Provenir, we provide risk decisioning platform. We help businesses like MoneyMe, Wisr, other fintechs, and banks and other lending companies automate their decisioning process around credit onboarding, KYC, compliance, and fraud checks. We help them by having them integrate external and internal data points all through a low-code design studio where they could run both machine learning models as well as scorecards to make these decisions. All right, with that, we'll just get into the topic around digital lending and customer centricity when it comes to digital lending. How do you enable that? So I'll just kick off with the first thing, and we just want to understand, as in at this point of time, digital lending, one of the things that it enables is really to offer personalized lending solutions. So maybe we kick off with you, Joanne, to start with. What are some of the key strategies that, not just with your business, but what you're seeing around in the industry, around tailoring of lending solutions? How are we personalizing this for the customer?
Yeah, look, I think ultimately, being an analyst myself, I'd start from saying, you know, how we do this is really only as good as the data that we've got to make the decisions on. So the key part of any kind of strategy starts from having really high quality data. And then on top of that, a really strong analytical capability to be able to understand that data and understand what that's telling us. And then a good system that will help us integrate data, integrate both external data and orchestrate that data in such a way that we can use that in our processes, whether that's to automate a check or whether that's to do something much more sophisticated and build some kind of model over the top of that data that predicts an outcome. Yeah, so we're doing that throughout the lending journey at Wisr. But yeah, as I say, it all really starts from having kind of that deep understanding and having, you know, access to a lot of data, right? So in order to do this, you need a lot of history, you need a lot of information to be able to understand what that data is telling you and be able to build sort of good strategies and good models.
Are you seeing, and you mentioned data, and of course that's the key to this, right? As in, are you seeing any interesting data sets as in that have been brought in to enable such personalization?
Yeah, look, I'd say there's what I call sort of traditional data, which is typically like credit bureau information. I would describe that as sort of traditional external data, and some of that has got obviously increasingly larger in the last few years, obviously with the sort of mandating of comprehensive credit reporting. But that data, I suppose, is quite traditional. And, you know, like you might have picked up from the accent that I'm from the UK, but, you know, traditional kind of credit bureau data has been used in these kind of strategies for sort of 20 odd plus years, right? Some of the more interesting data that we're looking at now is probably less traditional, sort of more transactional in nature. So, and that again has been for a number of years, but you know, the uses of technology to enable kind of pulling of transactional information, open banking type information and the like has enabled us to automate some of the more complex credit checks that are required to ensure we comply with responsible lending obligations. And then I think it's more sort of in the reg tech space as well, and sort of interesting, unique technologies that are doing something better around, say, fraud, or, you know, so for example, using OCR, using biometrics and the like to help us automate some of those more complicated KYC or sort of fraud detection processes. And that's sort of been a trend that I'm seeing more recently.
Thanks, Joanne. Clayton, you want to chime in there?
Yeah, certainly. There's never been a time like the time now to innovate. We've got a generation of customers that speed, efficiency, it's not an advantage, it's just an expectation. And when you think about our landscape in Australia 10 years ago, we're still very heavily paper-based, including paper money being used to transact. But we're in a different environment now, having customers' financial transactional data being very, very complete, having, you know, where they spend their money is they're leaving footprints that enables us to rely upon data to give them the appropriate experiences that they're looking for. And also it helps with the self-serve model. So, you know, a few years ago, it would be very common for you to go into a bank branch and speak to somebody and relay information. And what we find now very, very strange to do if you're thinking about going and setting up a mortgage in a bank branch by, you know, meeting a person and talking about that information, it still exists in many parts of our finance sector. So, for example, buying a car. It's very common for you to buy a car on finance, and it relies upon a person taking information and relaying that into a front-end screen that then goes into an email that gets sent to a bank branch or off credit officer that then has this relay back. And so it's not really digital. What we're seeing is really valuable now is these digital self-serve models. So in our experience, MoneyMe, we automated the experience with buying a car. It's transitioned what was otherwise an 8-day process, that is including settlement, security lodged on the asset, to now within 60 minutes. Now, 8 days to 60 minutes, that's a big difference, right? We can rely on pulling information about the value of the car through multiple sources. We can understand the customer's transactional behavioral data, their bank statements, their income, etc., their expenses. We can then very quickly price appropriately to that borrower. They can self-select how much they want those repayments to be and the length of term. And they haven't had to engage with somebody by relaying information in a very traditional and, quite frankly, intrusive way of somebody dealing with their own personal circumstances. And then finance gets set up. So the world is changing rapidly, but there's so many open spaces where technology is still finding its value in very big industries. Like I gave that one example, which is a car industry market, which has about $16 billion of Australian transactions happening every year. And that's still using traditional paper-based human intervention models.
What a fantastic example, isn't that? It just underscores the kind of impact that digitization and then financial services that are built on that digital platforms can enable. 8 days to 60 minutes. And I'm sure, you know, as time goes by, that 60 minutes will become almost instantaneous, right? As in nothing stops it from happening.
Absolutely. And if you go and think about the emotional buying behavior somebody has when they're thinking about their car, 8 days is a long time for somebody to wait for that thing that actually exists. It's in the showroom. It's costing the dealer money because he's paying finance on that car whilst it's, theoretically solve what takes 8 days of settlement. All we've done is moved 8 days inefficiencies to give the customer what they really want, which is to drive their car out of the showroom today, and the dealer the ability to have cash to go and buy another car and guarantee that sale in the process. It's fundamentally changing the consumer landscape. And there's more places for it. I don't know when a mortgage becomes a 60-minute process. I'm not quite sure. But certainly cars, which is like a mortgage, it's an asset finance. It can be done in 60 minutes flat. And you're right about that. For us, 60 minutes is what we say. But literally, if somebody, is in there and the car's ready to go, it's minutes. It's 16 to 20 minutes, and they're driving that thing out of the showroom. It's unbelievable.
Fantastic, and that's exactly the kind of impact that digital lending brings. And then staying on with the theme around, one, bringing in the efficiency. The other bit is around personalization, right? Again, traditional finance, the product is quite defined, quite rigid, and you would have, this is our terms, this is the mortgage product, and you would apply into it, or this is your lending product, it could be mortgage, auto finance, irrespective, right? But it's also the personalization. You could pretty much have terms, you could pretty much have a product which is very tailored to that particular borrower's specific needs, right? And Clayton, I'll stay with you on this. And do you see an opportunity, or have you already explored opportunity, or have seen around opportunities where we are personalizing the lending product?
Significantly. So if we think about where it starts is, so the banks have a big ecosystem. They cover, credit cards and all the products that we're familiar with. And in their ecosystem, they're pretty fragmented. So somebody that sits with a car finance, I'm going to use a bank's name, a Westpac car finance, and they have, Westpac bank accounts and all sorts, and a mortgage product with Westpac. When they found the 1-800 Westpac car finance people, and they talk about repayments and their balance owing, and then they ask, hey, and my mortgage product, how much do I owe on can I change my, well, that's another 1-800 dial somebody else number. We look at this ecosystem and we think, this is actually in one place. It's a wholesale market that gives everyone. It's not. It's fragmented with all these parts. Quite frankly, what we see is customers having a Westpac car finance product, a NAB mortgage product, and there hasn't been the opportunity under one ecosystem with digital technologies that allows that symbiotic engagement with a multi-product environment. All right, so that's the starting challenge. Okay, now for us, when we think about self-service using AI that understands all the products you've got, we can then personalize things. We can personalize the offers to you, so we understand that a credit card is probably an advantage for you, and we can personalize our credit card to the point where customer can pick their repayment terms. Right, they can pick. They're not just a one-size-fits-all 18% interest rate, but no, they can pick their repayment terms. They can self-select their credit, the amount of credit that they want to be advanced, and it's all self-serve. So that personalization comes with having one ecosystem, multiple products, self-serving, and also AI that enables us to move through a lot of data really efficiently. And then you get a really strong competitive advantage. And it takes time. And the modern borrower today, they're using that. So for us, we've got a credit card, car finance, personal loan, and they all operate in one technology environments that's very symbiotic and enables that customer to traverse across products, self-serve, one phone number if they were to contact us, etc.
Fantastic. Joanne, Wisr is into financial wellness, and that's something that has to be personalized. So really keen to hear your thoughts on this.
Yeah, look, I think our approach has been about trying to sort of re-engineer the entire customer journey. So, typically a personal loan has been sort of a transactional based relationship with the customer. They get the personal loan and they've gone and bought their car, or, whatever it is that they wanted to achieve with that personal loan, and tend to not sort of ever engage with their credit provider again until, say, they accidentally go into arrears or they need financial assistance because they lost their job. What we're actually trying to do is expand that journey and go on a journey with customers through the life cycle. So actually help them get access to information about their credit profile, understand their performance, understand how they're performing on that product and also other products. Give them sort of an application, a digital app that they can interact with to help them, check that product daily, pay off that loan quicker by rounding up their transactions. Also, get access to material coaching, for example. So really trying to, use the data that, traditionally we're using to make a lending decision, use that data throughout the customer journey to kind of more deeply engage with them throughout, have a sort of more, let's call it a bank-like relationship with a customer, but without being a bank.
No, that makes so much sense, that entire building that relationship with the customer using the data, right? We've talked about customer experiences being very, like the expectation of it being on demand. Clayton's talked about how they've reduced something which was 8 days into less than an hour. So we're talking about that kind of frictionless customer experience that fintechs and digital lenders are providing. I'll just put in risk there. I'll bring in risk into the conversation because we are living in a macroeconomic environment which is very volatile, and there is risk all around, right? So how do we balance while providing this instantaneous, frictionless customer experience, but having robust risk management in place? Risk assessment does require a great deal of depth in terms of analysis, and you mentioned data. I'm pretty sure that comes in here as well. But how do you find that balance between risk management and frictionless customer experience, Joanne?
Yeah, look, I think ultimately we have to sort of follow the regulation, right? So, some of the friction that is in the process exists for a reason, right? Because it's our obligation to ensure that the customer, the credit that we're offering that customer meets their requirements and objectives. We need to ensure that the credit doesn't put them in a position of financial hardship. And we also need to make sure they can afford the product. And all that, to be honest, is really what the regulation's doing. And it's all just kind of fairly sensible when you look at it at that sort of level. And then that sort of led to these processes where we require sort of high documentation. We require complete detailed verification, and we require to ensure that the process is explainable. And the innovation doesn't remove any of those requirements. The innovation has really been about how do we use technology and data to ensure that those requirements and that those checks seem as efficient and as seamless as possible. So where someone, for example, in a traditional sense would have obtained a pay slip and looked at that pay slip and compared that to your income, there's clearly a better solution for that now, right? There's access to data, there's access to transaction data, there's access to other sources of data. How do we integrate that data seamlessly into our process so that we can still ensure that we're doing all the requirements and meeting all the regs and the rules at the same time as making that seem like we're helping the customer on the way? Because, applying for credit can be a little bit daunting. Like, you have to fill in sort of, I think last time I counted, it was like 40 questions just to comply with responsible lending obligations, right? So how do we, rather than you providing all that information, make that as easy as possible, present that information to you in such a way that doesn't require you to, complete. So it could be that, we co-complete that information together and make sure that, it's presented in such a way that we can deeply understand that the product is sort of fit for your requirements, is not unsuitable. And also, we verify all the information to make sure you can afford it.
Thanks for that, Joanne. Clayton?
Yeah, we're operating in a really good steady state regulated environment. Exactly what Joe said, being, regulators' intentions are very clear, and they're actually pro business and consumer sentiment if you get it right. And surely, some things are slightly outdated, innovation slightly moves slightly faster, but the intentions are very clear. But where we get find ourselves in a really interesting predicament is we were advancing into dynamic decisioning, dynamic user journeys that alleviated, the need for onerous questions and things and time, that just were where binary pieces of information were not really adequate to make a credit decision. So we're having dynamic workflows. If you live with, in an environment that has multiple people paying for rent, we understand that. We ask specific questions in relation to that, as an example. So you get into this personalized dynamic decisioning workflows, which has been excellent. And we're able to really get clear on better risk management. So it's not one size fits all, personalized risk management, and actually speed and efficiency. So they're working hand in hand. Where we find ourselves really finding it quite difficult now is with the changing interest rate environment. Oh my gosh, the downstream impacts are significant. How do you price what is going to be the price of credit in a year's time? We've shown, that pricing what credit's going to be in 12 months' time isn't what everyone thought it was 12 months ago, right? So mortgage rates have gone up, credit card rates have gone up, personal loans have gone up, cost of living pressures are obvious. And so it's very interesting when you start thinking about the binary approach to understanding credit to now needing those dynamic decisioning points, those agility points of being able to look back very quickly, understand, trajectories of people's expenses, and then normalize what you might think is the future as opposed to what it is today. Only technology can do that. Sitting across from somebody hearing, what is your telephone bill, et cetera, what was it last month? Not looking back at the history of where things have moved in your personal circumstances, where interest rates have moved on their other credit products. Data is enabling us to now predict, where the balance of risk is going to be, and we have to price it appropriately. And so we're seeing the agility and the changing macro environment really testing. If we had a traditional, decisioning or credit model, same for Joanne, if we had a traditional one, we'd find ourselves in a really strange predicament of how do we rely on traditional ways as opposed to using data and contemporary ways to, normalize the macro noise that's happening every month, it seems.
Yeah. And you mentioned dynamic decisioning, Clayton. I would kind of also talk about, it's not just during the onboarding stage, right? It's not just the new customers that you're acquiring, the environment we're living in, the pricing of credit. There's so much of risk management that you have to do dynamically onto your existing portfolio as well.
Absolutely.
So can we talk about that, as in how, the risk that management that comes in and dynamically, how you're kind of managing your portfolio?
Yeah, for sure. So I'll give you one example. So cars, they've stood the test of time in Australia as a quality asset to invest in. Certainly as a lender, they've always been strong. Australians, there's fundamental reasons why investing in cars is really useful. So one is where they're always in Australia. These cars aren't, making their way to other countries. We're lucky enough to have the separation of a lot of water between us and anywhere else. And so cars stay in Australia so they can be found. So that's interesting. The second part is, in Australia, we use our cars fundamentally for dropping kids off at school, going to work, etc. So we look at car assets and we see the strength of car assets performing really strong through really troubled environments. But now what we've got is supply and demand issues. What's the actual value of a Mazda 3? So it's a safe asset for good reasons. But what's the actual underlying value of that asset? Well, is it 22,000 because that was in 2021, but it's now selling secondhand for 32,000? And when does that change? And what is the dynamic nature that we have to now have to contemplate changing supply, demand, inflationary issues? Because we believe those cars aren't going to follow the same pattern of price increases as we see in rent and other things. What's impacting cars for us is supply and demand. And as soon as those get fixed, what's the value of a secondhand Mazda 3? Does it normalize? Does it, is it impaired even further? We don't know entirely yet, right? We'll see. But those dynamic decisioning points for us enables us to move with understanding of supply and demand challenges. So when we give that car to somebody today, the dynamic decisioning looks at not the price of that Mazda 3 over the last 12 months, because that's irrelevant. It actually is interrogating what's the price of that car today? What are they currently selling at, knowing that supply and demand constraints need to be operating on real-time models. So when we look at the combination of CCR data that's real-time behavioral traits of somebody's, repayment obligations, as opposed to, their credit file being impacted by, when it's too late, it's actually real-time, understanding about their payment obligations, real-time valuations of assets. That's the dynamic nature that I described. That's fundamentally, it's paramount important for digital lenders. And it's actually our advantage. It's by far our advantage.
Yeah, I was about to kind of say that it's actually an advantage that, when you can bring technology and you could do that, that actually differentiates how you're managing risk within the business. To you, Joanne, as in on your existing portfolio, I know with your business, it's more unsecured. So how are you managing risk within the existing portfolio?
Yeah, look, I think the biggest kind of focus now, so typically a big focus around the sort of, let's call it the more sort of advanced analytics, the automation, the customer decisioning has always been sort of around originations, right? How do we originate the best credit through a seamless process at the best price? However, I think the real shift, over the last couple of years has been really around how do we ensure that the process to engage with customers who are going through financial difficulties is actually the best it can be, right?
Yeah.
Traditionally, all over the world, people miss payments, and banks and credit providers and everybody else calls those customers up and ask them to pay, right? Or customers lose their job and we call them up and ask them, to sort of provide evidence of that and do some kind of financial statement to understand what they can afford. And that really is quite archaic. And I think that's where the real innovation is kind of taking place for us, especially because we've built these tools to sort of go on a journey with customers, as I mentioned before, and engage with them, throughout their kind of product life cycle. How can we really innovate to provide options for customers so that if prior to them going into financial difficulties, we can be aware that there may be indicators of that happening. And then we can be very proactive in how we reach out and engage to customers, and how we do so using all the science and all the sort of optimization and credit models and the like that help us really understand what's going on and ensure that we can target the right level of communication that's not so intrusive through the right channel at the right time, so the customer can feel that we've got them in that time where they need support. Yeah,
that ability to be able to immediately recognize and reach out. I think that's almost such impactful business outreach. Before I go on to the next question, I just wanted to bring in the listeners into the conversation. We'll run a poll question. We've heard from both Clayton and Joanne about deploying data, as in the advantages of advanced technology with machine learning models, analytics coming in. What does the audience here, the listeners, feel the biggest benefit this deploying of data analytics brings in for lenders? Is it operational efficiency? Clayton's talked about it, Joanne's talked about it, bringing down the time significantly. Is it enhancing customer experience? Or is it actually something which we haven't yet talked about, which is expanding reach into those underserved segments of population? Where is it? All three are beneficial, and all three, I assume lenders would say it, but I just want to take a sense check on where the biggest benefit would be for the lenders. So the poll question would be on your screens. And if you could all vote, it'll be a good sense check, and we could kind of dig into the results after that. Do we have enough votes, Story?
Yes, looks like most participants have voted, which is fantastic to see.
How do we see the results? I can't say it yet.
Is it not on your screen?
Not on my screen. Is it on your screen? Clayton, Joanne, can you see the
Oh,
results?
what we can see is still the question, the poll.
Still the question. We can't see the results yet.
Not yet.
Okay, so I will share. We've had 48%, so almost half of participants say to enhance customer experiences. We've had 32%, so almost a third of answers is operational efficiency, and 20%, so a fifth, to expand reach to underserved segments.
Great, interesting results. Let's talk about the one which has been voted very less, and I wanted to kind of get both your views on this, Clayton and Joanne. Is it because in Australia we don't have much underserved segments or underbanked as compared to, say, Southeast Asia or South Asia? And then if I would be speaking to fintechs in the Southeast Asian region or South Asian region, for them one of the biggest drivers of bringing in data and technology is to actually reach to population which hasn't had access to certain lending products before, right? When you see these kind of results, what's your view on it? What's your take on it?
I can give you a live example. So a bank, I won't give the name, a major bank, has an opportunity to provide a mortgage to a family. And in this family, there's a person, he's a tradie, and he's been earning about $250,000 a year, and he's self-employed, and he's consistent because, you know, he's been working in the building trade, which of course has got an immense amount of, you know, demand for those skills. And his partner's a school teacher earning $70,000 a year, and the bank disregards the $250,000 income in the assessment for a mortgage. So they discounted quite significantly that $250,000 income earner, and they rely heavily on the school teacher with the $70,000 because it's mainstay, it's understood, it's you know, there's no volatility or consideration about that. And when we see this family situation, and you actually ask the bank and you ask the people, you know, within the bank, and they can't understand why, you know, somebody that's earning $250,000 a year is really not the prime applicant on the mortgage. The $70,000 income earner is the prime applicant. That's just one example because of legacy rule sets, right? There's no doubt from a credit risk and the ability for somebody to make the appropriate repayments, you look at the, you know, you look at the person with the higher income, particularly in an environment where that skill set is highly sought after, and time again shows that that person can certainly afford a mortgage. So that's interesting. Now, when it comes into this, we talk about democratization of financial services. So I think that third point talks about that. In some ways, there's an incongruence in rule sets that just don't make sense today. You know, that example I gave, but also in underserved markets where traditional credit scores are also influenced or largely influenced by your geographic location. So if you're Sydney-based, Mary from Mosman, when she first has a credit profile, starts off at about 600 to 700 Equifax profile, with no real clear reasons for it other than her geographic location. Betty from Bankstown is a different profile to our credit bureau, and that's largely because of the demographics. Now, when you look a little bit more at the contemporary nature of Betty, who's commuting to work, working really hard, is striving to become, you know, financially, you know, sustainable. And I'm not saying Mary's not, but Betty's working incredibly hard, working in the same office environment that perhaps Mary is working in. And what we look through to look at these underserved environments is because they're underserved because of traditional ways of looking at credit. They're not looking at contemporary ways of real understanding of income, you know, the career choices that people are making, the things that actually really governs us from thinking about credit and risk assessments. We're using still traditional ways, then those traditional data points aren't correct in that geographic example I relayed to you. So the benefit that comes back to your point, you're expanding reach to underserved segments, absolutely. There's a significant inefficiency based on traditional ways of looking at credit that we're trying to normalize. And in some ways, I think we can say we're democratizing financial services to make it fairer for people.
Do you see that with your business areas as well, Joanne?
Yeah, look, I think it's a really good example. And I always used to give a personal example, right? Which was when I, first applied for a personal loan, right? Back when I was 18, right? And the idea was I needed a personal loan to buy a car so that I could drive from town A, where I lived, where there was no jobs, to town B, where there was lots of opportunities and lots of jobs. So I could actually, get a better job in line with my degree. And in order to enable me to, be able to get that car, I needed to actually already have the better job, right? So once I get the better job, I can prove the income to be able to afford the loan. Now, and that's still a problem, right? And that's a problem somewhat limited by, the regulation around proving a current state of financial position. And I think that's something as an industry we can continue to sort of lobby on with regards to being able to serve those segments of society that are trying to, improve and better themselves. I think, students is a great example where typically they're just carved out of lending, right? A credit model is always predicting your likelihood to pay back, whereas a servicing assessment is what is your position today? Can you afford the loan today? And, in my example, I wouldn't have been able to get that car loan, right? But in, that car loan enabled me to get the better job, to better myself, to, go on and have a great career in risk management, I suppose. So that's the challenge, I'd say, for the industry, is to really try and work with government to find a way to make it more open and enable those people to have access to credit.
Yeah, I think it also kind of is down to the assessment. Clayton mentioned that as well, as in traditionally, if you look through a certain set of rules when you're doing this assessment, you might enter into areas which are beyond that particular individual's control, right? You're assessing an individual on their ability to repay on parameters which are not within that individual's control. A lot of traditional rules actually lead into that direction. With data, with technology, and that's where I think it's a huge enabler, is that you could kind of take all those, sieve through all that, and kind of just come into those data points which are speaking to that particular individual's ability to repay, and assess just based on those parameters and those data points, right? And yeah, so again, it's a huge, all three of those areas: operational efficiency, customer experience, and expanding reach are all the benefits that come out from deploying data and technology. But I guess from a social impact, the third point for me is the biggest, right? As in when you expand reach to these underserved segments, leverage on data and technology to do that, that's the biggest social impact a business can have. Yeah, so just wanted to bring that in as well. Just a mention to the listeners as well that you could put in questions at any point of time. I'll try to bring it in. So this is the way we would want to have this, is not leave the questions till the end. More than happy to take in any questions from the audience, and I'll bring it in as we speak through the rest of the topics. I'll move on to the regulatory area now a little bit. We've seen, Australia has been one of those, I wouldn't say pioneers, but one of those early adopters around data protection. There are clear regulations in place around consumer data protection. There's also been incidents around fraud, which have been picking up significantly, especially through the pandemic and post-pandemic. The data it clearly shows that fraud has been on the uptick. So while we set up digital lending, while we set up all this decisioning and risk management in place, again, how are you seeing technology enable protection against fraud, or making sure that the data, individuals' data, is protected adequately? Joanne, I think you'll be the best one to kick this off.
Yeah, look, I think there's been some great advances in technology to help us understand and protect, victims of fraud. So, for example, some of the technologies that help us understand biometrics, much more robust and much better at detecting whether a ID is not a fake than sort of the human eye, right? And another example may be sort of, technologies that help us scan documentation to understand that it's been fabricated in any way, which has been super helpful in helping us detect fraud. I think what I'd like to see, because I think a more recent trend has been around, victims of scams. So, we've seen examples in our business where, someone is completely genuine, and they are, coming to you to apply for a loan. They are the genuine person. Everything is genuine, but actually they're being manipulated behind the scenes by someone who's scamming them for money. So they're going, okay, apply with this lender, say these things. If they ask you this, say this. We've even seen people where, the scammer's taken over their computer and filled in the application for them and coached them through it. And then, taken that loan and other loans and, and their life savings and their super and disappeared, right? And I think this is like a really critical problem for industry and for, the victims, that I think we just need to get behind and try and do something different and better. And I haven't really seen any innovation in this space with regards to, it's both consumer education, but it's also, what technologies can be used or what models can be used to try and identify people at risk of being a victim, and are there any, say, transactions occurring in their account that might indicate that, someone is controlling them financially.
Yeah, I imagine I've heard of certain behavioral monitoring technology that's out there, which helps pick up any anomalous, like something which is looking very, very different from the regular behavior on an application. Those kind of signals come out as well. Clayton, your take on fraud prevention?
It's on the rise. We've seen behavioral traits of consumers behave just very different in the last 3 years. So, for example, we've seen transient people, students moving back to their countries, leaving their payment obligations for mobile telephone, with mobile telephone contracts, credit cards not being repaid. So we're seeing just some strange behavioral traits, with the movement since, pandemic stuff and change of, our approach to having, students, etc. in Australia. That's all normalizing now, but we've certainly seen a rise. And as a lender, data gets us far, but then also just common practice has to happen and kick in. So we have to take, appropriate measures, such as just reduction of exposure to certain groups, because the ecosystem in a lender's world relies upon diversification. So if you got concentration risk in either students, or if retail, employment environments, or certain just areas like including geographical concentration risk, that proposes a real problem, particularly with fraud. But if you have diversification where you've got, no concentration of risk in certain segments, you can manage things appropriately and keep the ecosystem really, really vibrant, all without any, significant catastrophic moves. So whilst fraud's on the up, we've seen where some of those fraud instances can be mitigated through biometrics, certainly bank transactional verification mechanisms that we've deployed enables us to really get clear that this is the right person we're talking to and engaging with. The understanding of visas using technology integration into, government databases to understand expiry dates of visas, etc. They're all working towards mitigating fraud, and it's working significantly well, but also comes back to that diversification across the portfolio is the main advantage for us.
Okay, we have a question from an attendee. I think it's just a question to confirm that, with the self-serving lending applications that you mentioned, Clayton, does it mean that it's fully automated now presently, where there's no credit officer who's actually assessing the application before settlement?
Yeah, and that's in most cases. So where there's, outliers where information might not be, needs to be verified, if there's an inconsistency in what we're seeing in somebody's financial circumstances and what they're, disclosing to us, then we need to understand and inquire further. And so a credit officer in the contemporary way is very different to, what you might be imagining a credit assessor doing. So the role of a credit assessor in the past would be to actually work through risk tolerance levels about the information they're receiving, set credit limits, etc., valuation of assets. That's done very differently under an automated application journey. So this automated application journey sets the credit limits using regulatory controls embedded in the business. It uses, credit risk controls. And so the credit officer is largely a verifier of process and verifier of information. So that's why things can be really fast. So to answer the question, yes, limited human intervention into a highly automated process, so straight through processing, but in circumstances that it requires an intervention, the controls of credit assessment are still left to the ecosystem, the controlled environment, as opposed to the human. The human might be required to verify certain instances that gets flagged as anomalies. So it's a really efficient model, but the benefits of it not only are, customer efficiencies, but regulatory controls are not left to human interpretation of law. They've embedded into the controlled environment. Credit has to be assessed on income, on serviceability, on, standards, etc., which is very valuable.
It's more the exception than the norm.
That's right.
Actually have a credit officer.
It's the exception, and it's a verifying process, not what we understand credit, assessment and to be in the past, which was I'm authorizing a value to you. No, there's controls in that's still automated, even in those exceptions.
Yeah, just to confirm, is the same with Wisr as well, Joanne?
Yeah, look, yes, broadly, but I might add as well that your sort of automated process when it comes to making the actual credit decision, the approved decline decision, I'm not talking about the sort of verification here, which it is, as Clayton says, someone to validate exceptions. But I think the actual approved decline decision is only as good as, the last time you built and validated your credit model, right? And there'll always be certain pockets or certain segments that sort of fall outside of your model development sample. For example, you've never lent to a certain cohort before. And therefore the model under or over predicts the risk of that segment. And that's where someone with expertise comes in, right? Your credit officers or, credit analysts now are actually people that can, look carefully at these kind of cohorts that maybe are underserved, or, typically your model would say decline, but you want to allow some of them to come through so you can build better models in future. And also, serve more of society where there is those groups that you actually want someone to look a bit deeper and make a decision. So I think there is still definitely a role. I often say to, the credit analysts in my team, you're going to have to make the really hard decisions now. Yeah, and I think that role is evolving as well. Those people are becoming more around, looking at the analytics and actually helping, supervise the machine learning, I call it. I think most sort of approved decline credit models will always be supervised, to be honest. And that's where the expertise is, changing, and there's lots of opportunity for growth still.
Absolutely. I'm conscious of time, so we'll move to the next question, which is, as in, staying with the regulatory nature, but we've seen the recent kind of decision from Australia to regulate, with the new laws that have come in to regulate BNPL services as a consumer credit product. Again, with regulations coming in, would you feel that these are necessary? I've seen articles in the media which are both pro and against the new laws coming in, where BNPL comes under consumer credit. How do fintechs view this? These increasing regulations that come in, increasing oversight that comes in. Is it necessary? Is it what, as some even within the BNPL industry have talked about, is that it is absolutely necessary for the industry? It brings order, it helps control the risk, or do you feel that this stifles innovation? BNPL was a truly innovative product which came in and scaled very fast. Do regulations stifle innovation in fintechs, where the businesses are coming up with new products, new ways of accessing borrowers and lending to them? So I know there's a poll question out there. We'll have the audience chime in as well with what they think and what their view is on regulations coming in the space. But as they are voting in, Joanne, Clayton, your views on this. Joanne, you want to go first?
Yeah, keen to see what the vote says as well. Look, I find it quite unusual that it's taken so long to regulate like what technically is a credit product. Like, you lend money to people and they pay you back over some terms, like it's a credit product. Like, I don't know how we ever got into this position that it was carved out of the regulation. It's sort of bizarre. So I think it's kind of about time, because the view of the regulation is like, don't lend to people who can't afford it, and don't give people a product that's going to put them at risk of financial hardship. Like, I think we can all sort of agree to that, right? Like, it seems completely nonsensical why you would say, oh, unless it's this type of product that we're going to distribute at point of sale to, young people. Like, anyway. I worked at GE in the UK 20 years ago, and one of the main product offerings was buy now, pay later. And guess what? It was a credit product and it was regulated. So, like, about time is my view. I don't think it'll stifle innovation. The innovation hasn't really been, around that sort of how we distribute that product. The exciting innovation is how all the stuff we've been talking about today. How do we use technology and data to remove or improve, and create more of a streamlined process. So I think the innovation's still there, right? I think it always was.
Very clear on where you are there. On your question on that, Clayton, what about you?
I just think there's guardrails, and these guardrails are useful, and you should operate within them, and they shouldn't stifle innovation. And by the time I think these guardrails start changing course, for the appropriate innovation, that's, they're probably designing it because there's, misuse of what the intentions are trying to do. So in our experience, I haven't really seen regulation stifle innovation. And I'm not saying, Afterpay success is, if it was operating in a regulated environment, it wouldn't be successful. I don't believe that. Like, there's no harm in asking a person, about their financial circumstances and their age, and a few things that identifies that, what, $2,000 is a fair, responsible line of credit that you can use. Like, I don't think that's a hard ask. Like, everyone else has been doing it for forever, and we do it with, a lot of onerous measures. So I think there's guardrails that are there. I don't think they can be misused. And I think regulations got relevance, to protect consumers. Otherwise, unfortunately, there are certain rogue behaviors that do happen. And that's what it's intended to do. So I think, my view is, like, it hasn't stifled innovation. Certainly there's some, some complication that exists between, environments like consumer protection laws and business protection laws. They're very, very different. You can lend a car to a business and have pretty much no regulation, under any form of requirement, but to a consumer, it's significantly different. But the business owner is really a consumer of credit. It's interesting. So I think there's still significant gaps, but all on the balance of things, I think it makes sense. I think there was a question that related to, regulation that covers open banking, and also regulation that might come into effect around using, screen scraping. I think absolutely. Here's an example where in a digital world, if we didn't have mechanisms to rely upon receiving transactional data, so using screen scraping, we would be in a world of pain right now. We'd have a very, very challenged environment to service customers and understand data and adhere to regulation, and also fraud. Doctoring PDFs are easy today, changing, transactional data. So having access to screen scraping technologies that enables us to get the appropriate data in the appropriate way, it's been phenomenal that regulation hasn't gone and stifled that approach. But certainly and I think everyone's plan is to certainly adopt the open banking regime when it's adequate enough to be able to, replace screen scraping approaches, to move to open banking, more standardized, secured layers of receiving information, etc., and participation from, the person that owns that data in a more common way. I think that's excellent. So we're prime and ready for open banking. But certainly over the last, in MoneyMe's existence, we're using it for now 10 years. We used an application out of the US called Yodlee because it didn't exist in Australia. And then we co-authored, something that helped us having a white label open banking type solution for borrowers. And then we shifted that to now being, mainstream for everyone that's using it in Australia, which is helpful. So we're advocates. We had a 23-year-old, was our average customer age for MoneyMe 10 years ago, because that was, what made sense at the time. And now that 23-year-old is, they 10 years later, they grew up in a digital environment. They need digital solutions, and they're not downloading PDFs and printing or scanning or sending. They're not doing any of that. So certainly we see that having access to customers' data, using technology, particularly open banking, of course we have to all move to that standard.
It's an eventuality, right? I think screen scraping solves the problem until open banking becomes adequate and everyone 100%. Participates, which is which might need a regulator to come in and actually necessitate participation in that, right? So, Joanne, your view on the question there from Ben, which is around the consultation that's going to be starting on screen scraping.
Yeah, look, I think I mainly agree with what Clayton said, right? Like where the solution that's available is pretty seamless. It still allows for customer consent and it's still pretty secure, right? If open banking gets close to and can kind of create a similar solution that works for customers and customers adopt it, because I think the adoption in the UK has been pretty slow. It's pretty much been a non-event because it's been too complicated. But I think if we do it right and learn from, our counterparts across the pond about how to make it work, then we can make it work and consumers will use it and we'll be ready. But yeah, it's got to be a good solution, because going backwards and going backwards to like paper-based PDFs is just a bad outcome for everyone, right?
Yeah, I think it's about the guardrails that Clayton mentioned, having those guardrails to make sure that it is permissioned properly. There's no data leakages that are happening through the screen scraping, and the encryption that needs to be in place. It's just, defining those standards around that.
I think on open banking data standards as well, like the industry's done, probably 5 years of work on CCR data standards. It's pretty good. Was kind of led by ARCA, who is sort of industry body around this. So I think it's got to be an industry-wide approach, right? Because no one's going to use a solution where the data quality is poor and it doesn't provide, a good sort of coordinated way to categorize transactional data into something that becomes usable and can create decision points. Like unless we can get that right as an industry, then it's going to be incredibly slow.
I agree. And the results of the poll are out there, which basically I think most of them are in line with what Clayton and Joanne mentioned, which is I think these are necessary regulations that are coming in. They're helping kind of control the risks in the market. I know we're just kind of getting over time. I'll try to kind of really wrap up here. Just final views on future trends. Joanne, starting with you. We've talked about where we are presently in terms of leveraging on data, technology, and having dynamic decisioning provided for great customer experiences. Where do you see this heading? What are some of the future trends that you see from where you're sitting?
Yeah, I'll probably go back to what I sort of mentioned earlier. I think the innovation's got to come at more points within the customer journey now. And given we are at this point in the credit cycle, I think having better solutions and better sort of innovation and better data and analytics around how we engage with customers who are struggling, that's probably where I see things moving.
And Clayton, do you?
Nothing too much to add to that. Joanne's covered that.
Hey, great. Thanks, Clayton, Joanne. This was fantastic hearing from you and getting those great examples from each of your businesses. I'm pretty sure the listeners have enjoyed the conversation as well. Thanks to Fintech Australia again for putting this together. And thanks to everyone who's dialed in and listened to the webinar. Thanks, everyone. Have a good rest of the day.